Thanks, Steve, and good morning, everybody, and welcome to the Investment Division section of the Commission's Industry Seminar. I am very pleased to have here, not necessarily on the stage with me, but Mark LePage is in the audience, and you may have heard that, unfortunately, he's been somewhat below par recently. Although the good news is he's on the road to recovery, he's still not back up to full speed, so the bad news is that I will deliver the majority of our presentation. But thankfully, Mark will join me towards the end just to wrap up, and of course we'll both be available for any questions. Yesterday, many of you will have heard William speak about why we are regulating, how we are regulating, and how we are innovating. And today, we'll take the same themes and take the time to drill down into them, focusing on the investment business division and the investment sector. Using the headings of facts, flags and the future, during this presentation we'll cover first an overview of the sector using the statistics and other data that we gather. We're often asked for statistics in addition to those that we publish on the website. And as a result, on a couple of previous occasions at the industry seminar, I've promised to provide you with a more in-depth examination of the statistics. And I'll be covering some of those statistics in some detail today. Second, we will discuss our findings from the supervision of the sector, derived from triage events, engagement tasks and thematics. Some points we make under flags may seem fairly mundane or even statements of the blooming obvious to many of you, in which case you can leave here satisfied you're doing everything correctly, or perhaps you'll leave with a mind to just checking the risk areas that we discussed today with your own firms. Finally, we will look to the future and to what you might expect from us in 2018. We will provide details on the thematic we have planned for Q4 2017 and into Q1 2018, as well as announcing a couple of self-assurance educational events that we're planning for next year. What do I mean by self-assurance educational events? Well, here's a brief recap for those of you who may not have been present yesterday when William described how the Commission would be seeking to evolve the educational sessions provided to industry to help you, or those of your teams who attend, to derive maximum value from them. At such events from now onwards, you should find we will normally aim to state at the beginning of an educational session what outcomes in terms of knowledge acquisition should be achieved by those attending. All educational sessions will ask you to reflect on how you're doing in comparison with that we've been talking about. And we will generally provide those attending with a themed self-assurance help sheet or questionnaire at the end of the session, which the person attending will be able to take back to their office and discuss with colleagues. Indeed, my colleagues in financial crime started the ball rolling earlier this morning. These questionnaires are not expected to be too onerous, and as a rule of thumb will be limited to between 3 and 5 questions. The questions will be open-ended and thought-provoking in order to provide the consideration of key risks. And firms, importantly, will not be required to submit responses to the Commission. The type of events I'm referring to have thus far from investment been outreach on a subsector or association basis. For example, meetings with the custodians, with the GSCCA, with GIMSA and with GIFA. And we did run a town hall on MiFID II led by Andy Sloan. As I say, we'll provide further details of our future plans later. So in the vein of the educational events, my aim for this year's presentation is to share information in an as helpful and informative manner as possible. And I thought it might be helpful just to start off by showing you a slide of the division's organogram. The advent of the online services portal and the centralisation of the authorisations team may make it seem that you have less contact with the division members than you perhaps once did. Many of you may see this as an advantage. Others might feel the interaction has become more automated than perhaps even a phone call. But as you'll see, there are still a good number of familiar names in the team. And yes, that is Tom Jones, but not the Tom Jones. But there have also been a smattering of new joiners. I hope you'll feel that you can still pick up the phone to us, despite the automation of our main point of contact, and still ask us questions as you need to. But being careful to note that we're not there to replace your compliance officers. You might also note that the structure of the division, as shown here, is not determined by impact level of the firms. As we end 2017 and move into 2018, This will allow the team to be more flexible and will ensure a cross-fertilisation of the skills of the team. There are benefits to industry in this approach too. As well as the obvious one of the whole team being knowledgeable and experienced across the board, it provides the opportunity for a fresh perspective on a licensee, which is positive for the licensee too, as it will naturally erase any unconscious bias, and it eliminates any chance, however remote, of an over-habitual relationship developing between a licensee and a member of the Commission team. I should also point out at this stage that I do not have 3 PAs, as may be misconstrued from this slide. I'm not that special. The administrators, Martin and Sue, have a wide range of roles, including processing the statistics and other online returns, and Katie is my PA, but I only have 1/3 of her time, sharing her as I do with 2 other directors. So moving to the facts and to the big picture. At the end of June 2017, the AUM for Guernsey funds, and just to be clear, I'm focusing on just the Guernsey funds here, was 211 billion, across a total of 810 funds. This slide shows that over the last 4 quarters, the AUM has risen and the number of funds has stayed pretty much static. Looking back a little further, this has been the pattern for a good number of quarters. Indeed, the last 8 quarters, the AUM has been on the increase. So whilst there's not been necessarily significant growth in the number of funds, the number has at least been holding steady. Taking a closer look at the closed-end schemes, the AUM has grown by 15 billion over the year and the number of schemes has increased, albeit by 12. And taking a look at the main investment activities of those 658 closed-ended funds, we are known and identify ourselves as a jurisdiction of private equity expertise. And indeed, as is obvious from this slide, we have the best part of 400 private equity funds, so the statistics back that up. But we do also have all these other types of funds as well. This is because, as you know, administrators and service providers on the island are able to transfer the skills required for private equity to other asset classes, and indeed the majority do, even if only into infrastructure funds or venture capital funds, which may arguably be a subsector of the PE sphere. Another indication of the sector diversification is that in addition to the types of funds listed here, we have over the course of the year considered a range of innovative asset classes or innovative uses of the existing products, including structuring a licensee as an ICC, contracts for differences, and use of the MLP for the non-EU markets. Just focusing on applications for a further moment, over the year to date, 43 funds were authorised or registered, and of those, 37 were registered, with 10 being established as PIFs. But what does that actually represent? Well, the majority were from existing promoters, with a couple coming from new promoters, with a range of investment strategies from PE to sustainable assets to telecommunications. We do continue to receive interest in the PIF, and in fact, leaving the office today, I saw there was a new application come in the post. And I recently accompanied Guernsey Finance on a roadshow to New York, where the concept was well received by the PE houses and advisors with whom we met. Turning now to the open-ended schemes, AUM has remained relatively static over the past 4 quarters, as has the number of schemes. The predominant investment style, not unexpectedly, is equities, but again there is a wide range of other investment styles. In a combination of the experience of the closed-ended and open-ended schemes, the non-Guernsey schemes have seen an increase in AUM as well, but a decrease, although it has stabilised over the past 3 quarters in the number of funds. In this sector, the main investment style is fund of hedge funds, and given that the vast majority of the non-Guernsey schemes are Cayman incorporated, this makes sense. But other than that, the investment styles are very similar to those of the Guernsey open-ended schemes. So drawing the Guernsey funds and the non-Guernsey schemes together shows a not insignificant increase in AUM over the past year, together with an overall stable number of funds. The statistics for the end of September are still being finalised, so I apologise I don't have them here on a slide with me today. But early indications are that the AUM and funds have remained static over the 3rd quarter for this year. Just talking slightly more on statistics for a moment, In September, we met with Barnaby Malloy of Guernsey Finance and Mike DeHaff of GIFA to discuss how the Commission, GIFA and Guernsey Finance can work closer together to provide Guernsey Finance with the relevant statistics to be able to promote Guernsey as a jurisdiction of choice for funds business, and for all three organisations to gain a closer measurement of funds sector performance through statistical analysis. The information we currently publish is the sterling value of AUM split by type, closed-ended, open-ended and on-Guernsey, together with the number of funds and the split of asset class, pretty much the information that I've shown you here today. In addition, we do provide Guernsey Finance with the AUM in sterling split by hedge funds, private equity and property funds, and the number of Guernsey funds split by the same sectors. Guernsey Finance and GIFA have also requested the number of managers using the national private placement regime to market into Europe, the number of private investment funds and the number of MLPs. There is nothing confidential or identifiable in this information, and so we see no issue with its provision from us. More tricky to satisfy is Guernsey Finance's request to provide the sterling value of new fund launches. We are considering how we can best achieve this whilst ensuring we still maintain confidentiality. Understandably, Guernsey Finance would also really like to have information about the geographic origin of the investors in Guernsey funds. At present, we do not gather this type of information, other than in the context of the AFMD marketing rules and the use of the national private placement regime. Sorry if I clicked ahead. Sorry, there we go. Which is illustrated by this slide. As our discussions with Guernsey Finance and GIFA progress, it may be that we consult with industry as to whether the geographic origin of the investors and other statistics would be a worthwhile collating. Of course, our primary purpose in collating the statistics is for regulatory reasons, and in this world of increasing big data, I can see the regulatory advantages for collating information around distribution channels. Just back on MPPR, we are commonly asked for these statistics as a means of determining how successfully Guernsey funds are marketed into the EU and EEA. In truth, I do not think we're receiving the full picture here, and as part of the consideration of the statistics with Guernsey Finance and GIFA, we may reframe at what point we receive this information, perhaps moving to the point of application for the registration or authorisation of the funds, as opposed to a notification at a later stage. Moving away from funds for a few moments, we have not for some time now issued the statistics for the asset managers or stockbrokers. This was as a result of a rebasing exercise that we conducted during the move to the online submissions. As part of the discussions with Guernsey Finance, we are considering reinstating the publication of the figures. To give you a flavour of the statistics for this part of the sector, as at the end of Q2 2017, gross assets under regulated activity stood at 51 billion, and the turnover of stockbroking activities was 6.2 billion. These statistics are based on information from a population of 35 licensees, each of which has its primary business asset management or investment management for private clients or stockbroking. So, moving to flags. One of the main means by which we identify the need to look more closely at a firm is through triage, or trigger-based supervision. Triage, as the name suggests, is a first response to events or triggers. There are a number of different triage types. Listed here in alphabetical order, you can see examples derived from a range of different sources. Sorry, they keep on coming. Apologies, this was supposed to be automated. Oh, there we go. At the top there, now highlighted, is the account's emphasis of matter. And then at the top right, apologies, this has gone wrong. There's data security, which we derive from returns that are provided to us. And then finally, mis-selling, which we receive information on that from complaints that we might receive. Having mentioned breaches, because a number of these trigger types come through from the breaches that we have reported to us, I just wanted to, as an aside, remind everyone that a breach is a breach and should be treated as such and should be recorded on an appropriate breaches register. Whilst the regulatory response to breaches may differ, and therefore some may then be referred to as technical, they are all breaches. This is one of those statements of the blooming obvious that I have referred to at the outset, but I only raise it as a result of conversations that we have had with licensees, which indicate there may still be confusion on the matter in industry. I'm hoping the tech is back under control. During the last 12 months, the following trigger types were the most prevalent, with conduct issues, breaches of rules and corporate governance featuring most frequently. Our actions as a result of these triggers differ depending on the particular circumstances of each case. However, many of you will be aware that for late accounts and accounts with qualifications or other audit modifications, we have introduced a specific policy. The policy was introduced last year, and as we have previously commented publicly, it takes effect from the point at which the submission of the accounts has passed, whereupon we issue notice of the intention to impose conditions. The relevant designated manager, together with the board of the fund, is given 28 days to submit the accounts or to provide representations as to why the accounts are late, but conditions should not be imposed. If during the 28 days the accounts are submitted, with, very importantly, a clean audit report, then it is highly likely the conditions will not be applied. The number of times conditions have been imposed is, I am sure, far lower than most of you might imagine. And following the end of June 2017 submission date, being the point through the year with the highest volume of accounts submitted, we issued notice of conditions to 11 funds. It's pleasing to note that of those 11, 8 submitted their accounts for clean audit reports within the 28-day notice period, meaning imposition of the conditions was not necessary. Of the remaining 3, 1 had changed its year-end, 1 had not yet launched, and the other requested a modification in respect of 2 underlying sub-funds, resulting again in no imposition of conditions. It is, of course, important to remember that where accounts are late, the penalties will apply regardless of whether conditions are imposed. And also, it's important to remember the Commission cannot allow a situation where company law has been breached. During the year, we completed 11 full risk assessments, 10 engagements and a number of customer engagements. The full risk assessments predominantly, but also the engagements, resulted in around 65 risk mitigation programme actions being issued. What did we find that might be helpful to share with you? Well, unsurprisingly, like the triage types, governance continued to be one of the risk areas where we see most need for improvement, or where we need to impose those RMP actions. Examples included requiring firms to formalise their assessment of risks facing the entity in the jurisdiction and ensure oversight of outsourcing was reported to the board. Both of these, taken from more than one firm, I hasten to add, are symptomatic of a general over-reliance on group functions and giving insufficient attention to the interests of the local firm. During the engagements, we cover a range of topics including GDPR, which are not necessarily directly correlated to a requirement of a rule, but if not adequately addressed by a firm, could result in potentially damaging outcomes. Where we have seen examples of good practice, and we have seen them, they are mainly derived from, and again this may sound like another statement of the obvious, they are mainly derived from a good understanding of the firm's business. As well as pre-mandated engagements, as a result of PRISM, we also undertake customer engagements. These may be as a result of a request from the firm, for example, to meet with the Group Compliance Officer whilst on a visit to the island. We are happy to do this as far as resources and notice allow, as we recognise that those firms who are a part of a wider CI, European or even global group often have a policy of updating the regulator in each jurisdiction in which they operate. It also affords us with an opportunity to get an insight into a firm with whom we might otherwise only have little interaction. Customer engagements may also come about as a result of other information that reaches us. For example, we may decide to meet with the board of a firm following a number of complaints, or where we are aware a significant piece of business has been won or indeed lost, or that key staff have recently left the firm. Customer engagements can take various forms. For example, a singular or a series of meetings on site or at the Commission's offices, or even a request for specific documentation which we will examine at the Commission's offices before deciding whether to meet with the firm. Another example of a customer engagement is an exit interview with the CEO or equivalent upon them leaving a firm for whatever reason, resignation, retirement. Governance matters continue to come to the fore in the thematic work we undertook over the year. At last year's presentation, we had commenced the thematic on governance, risk and compliance frameworks of fund managers and fund administrators, which we conducted jointly with the Financial Crime Division. The feedback from the thematic was issued last week, and whilst I encourage you all to take the time to review the findings, both investments and those contained in a separate report from our colleagues in financial crime, I appreciate you may not have had the opportunity to do so yet, and thought it was worthwhile just running through certain key aspects with you. As you'll see, the objective of the thematic was to understand how fund managers and fund administrators have structured their governance, risk and compliance frameworks to mitigate governance and compliance risks in relation to collective investment schemes. This was chosen because as a key theme to emerge from supervision had been a weakness in the application of effective compliance monitoring arrangements. The thematic followed the Commission's standard approach of a questionnaire, this time sent to 34 investment licensees, predominantly rated low impact, and following the analysis of the responses, a number of licensees were identified for a visit. Finally, as I mentioned earlier, the thematic has culminated in the production of a report from each division. The thematic did focus on low-impact firms because, as you're aware by now, thematics are one of the main means by which we interact with low-impact firms. However, the findings are relevant for all firms. What were the findings? In both reports, we've identified case studies, areas for improvement and points of note from each of the areas covered, being oversight by the board and take-on arrangements and ongoing review. The latter of which included scheme take-on arrangements, frequency of review of a scheme's particulars, and the frequency of the review of schemes' performance, method and challenge evaluations. I'm going to highlight a couple of case studies and areas for improvement from the investment report, and will leave you to follow up with the rest in your own time. Amongst the case studies, we saw one fund manager intending to conduct thematic reviews to assess the risks and identify trends across its funds to be provided to the board demonstrating suitable oversight. Whereas we saw in one licensee, compliance reports required improvement as it did not provide sufficient detail for the board's review with regard to the compliance monitoring tests. Without appropriate information, the board cannot take the necessary steps to address the issues identified. In another case study, we have explained how one licensee, under the topic of method and challenge evaluations, considered each investment individually and requested support for unlisted or inactively traded valuations. Further, in appropriate circumstances, it reviewed discounted cash flows and queried assumptions, particularly where a price had changed significantly. This licensee had often challenged the rationale behind an increase in price of an unlisted investment, resulting in a valuation adjustment. We recognise that these specific controls may not apply in every circumstance, but are a good example of additional controls employed by an administrator. At the other end of the scale, we consider improvement was required where one firm noted that there had been no reason to challenge the valuations provided by connected parties in the last 12 months, as valuations had been discussed and accepted by the boards of the schemes or their general partners. This does not suggest an appropriate level of assurance through evidence gathering or testing. As 2 points of note, we have included a number ranging from the Commission's expectation of tolerance testing to the key events we wish to be kept informed of. We do hope you'll find the findings of the thematic helpful, and thank all of you that participated in the thematic. As well as the Investment and Financial Crime Division's thematic, there was, of course, the Commission's 2017 thematic review of investment and long-term insurance sales practice, undertaken by the Conduct Unit, which also impacted firms licensed under the Protection of Investments Law. I'm aware that many of you may well be staying on for the next session from the Conduct Unit, so do not wish to steal Rose Stevens' thunder here. However, the topic was chosen to help consider the effectiveness of 2 factors designed to have a positive influence on industry behaviour in relation to advice being given to retail clients. Firstly, the Commission's 2014 thematic report on this subject identified key areas requiring attention across the sector. And secondly, the implementation in January 2015 of the Guernsey Financial Advice Standards introduced the requirement for firms to authorise qualified and competent individuals to provide advice to retail clients. With firms being able to charge commission, the requirement for disclosure was enhanced to facilitate a clear and informed decision by clients to whom this advice is given. The Commission also streamlined the conduct of business rules and related codes for the investment and insurance intermediary sectors. As is the purpose of thematics, this thematic review has allowed engagements with firms which do not form part of the Commission's structured engagement plans, and has again highlighted the diversity of the investment and insurance intermediary sectors in Guernsey, and have provided assurance that the industry has, on the whole, responded well to the Commission's messaging. I will leave it to Rose to cover the rest of the findings and provide further feedback in more detail. However, for anyone unable to attend the Conduct Unit's presentation, it will of course be available for you to view at your leisure on our website in due course. In any event, many of you may have attended one or other of the separate workshops that the Conduct Unit hosted for financial advisors and compliance officers, focusing on their observations and conclusions of the thematic. Last year at this event, we showed you this slide, identifying potential thematics for the future, and we have now completed 2 of those thematics. Today I can reveal that we will be undertaking none of those listed below those 2, but will be in fact undertaking a thematic on the transparency of management fees. The thing about themes is that new ones are always emerging and we need to react accordingly. And like other regulators, we are concerned about the transparency of management fees. Since 2016, we've been tracking this issue, both in the retail and institutional space. We've also read the final report of the FCA's Asset Management Market Study, noting the comments about single pricing and other matters raised. And in monitoring MiFID II, we are mindful of its support for the unbundling of fees. We have identified a range of subject matters that we wish to explore as part of the thematic, split by retail and institutional funds. In funds targeted more towards retail investors, we intend looking at the precise constitution of the fee, to what extent this constitution is fully disclosed to investors, and the amount of trail commissions paid and the number of distribution channels to which they are paid. In more institutional investor funds, particularly private equity and infrastructure, we will consider the transparency of carried interest calculations, including the controversy over subscription line financing, how they are accrued and how they are treated in the financial statements. At present, we are aware that there is no clear view within the accountancy profession as to whether they are debt, equity or derivative. The focus on retail funds will help to inform us in the consideration of a review of marketing rules, and specifically whether we should introduce a requirement for key investor information documents, or KIDs. The next step for us on this thematic is to finalise the questionnaire we are currently drafting, and we anticipate issuing it prior to the year end. As I referred to earlier, we will be running regulatory self-assurance events, including one on online submissions. We felt this would be useful as we've seen a number of instances where forms are not being completed correctly. For example, with the forms 142 and 143 being those forms that accompany the submission of investment licensee and fund audited financial statements, from a sample of 300 fund account submissions, 100 had an emphasis of matter or qualification, and 61 of those 100 had failed to disclose on the form that the accompanying financial statements had been qualified or had an emphasis of matter. Though equally we recognise that some forms would benefit from further explanation or guidance from us. For example, it is inevitable with any capital adequacy derogations requests that we will ask for further information, or indeed in many examples the derogations themselves are not actually required, and the opportunity to discuss this with you would be advantageous to both sides. We also intend to run an event around the outcomes of the next thematic that I've just described, and there will be another update town hall on MiFID II. So I'm now pleased to say that I'll hand over to Mark to wrap up in terms of what else to expect in 2018, but I'm sure you will forgive him for remaining seated while he talks to you.
Thank you, Emma. Well, a colleague of mine, as I walked up, well, I didn't walk up, actually, I had to be driven up here, which was a bit of a blow to my pride as well, but a colleague of mine said to me that the only way I was ever going to keep to time was if I was unwell. So here you are, ladies and gentlemen, this is a first. So what else to expect in 2018 other than me keeping to time in 2017? Well, there's always a certain amount of crystal ball gazing, and as Emma's slide showed on thematics, we do have to suddenly change those areas that we are thinking of focusing on. What I can say to you for sure, because frankly it should have been done by now had I not been unwell, is that we will be publishing the revised registered fund rules and prospectus rules, and I would just comment there that we have taken account of your feedback. Thank you to those of you who did give feedback, and we have taken account of your feedback that we need to make sure that we get the relative responsibilities for the preparation of the prospectus correct. And so that will be incorporated in those changes. I had also trailed for many, many months with the GIFA Technical Committee that we will be looking to consult on new client assets and client money rules. In particular, what is exercising us there is the specific definition of what a client asset is. In the old days, it was quite straightforward. I'm not so sure that is quite an easy definition and demarcation line now. Now, speaking of consultations, we met with GIMSA earlier on this year, and one of the feedback statements made there was one that I thought was very fair, which is that we tend to issue extraordinarily long documents and don't say enough about what it is that we think you guys should be looking at, because we can't quite work out whether we've got it right or not. So we will be looking with these consultations to be putting more pithy summaries out at the start that will give you a lot more pointers about those areas that we're looking for comment. And just on a more macroeconomic basis, some of you have experienced the dubious joy of very random letters from me asking how you're considering particular risks in the funds to which you administer. Well, the two areas that have been concerning me over the last couple of months, in fact, Emma got a couple of texts from me when I was lying in hospital, at which point I was firmly told to stop worrying about work. But the two that have been worrying me have somewhat been crystallised a little bit over the last couple of days. First has been the volatility within the high-yield debt sector. And secondly, the softness of the London property market, and clearly my concerns there are shared by the Chancellor of the Exchequer, given what he's done in his recent budget. Very much in contrast to last year, we haven't talked at all yet about MiFID II. The comment that we will just make about MiFID II is that clearly we continue to look at it and follow it with interest. However, if we decide not to adopt MiFID II, we would have thought there are some potential opportunities there in the asset management and stockbroking sector in particular over the ability for you guys not to have to follow what seem to be on the face of it some quite onerous buy-side requirements. So we will continue to look at that, but it does seem to be one area where there might be some opportunities for the Guernsey sector. And with that, the shortest speech I've ever given at one of these. Thank you for listening.